Is my entry relatively close to the base? I call it the base, right? Or the movement monitor for the time frames I am considering. Obviously, mind the color of the movement monitor as well. Let's go back to storage, right? Is it close to the base? Here is a great example of no, it's not. This is a high risk long. Could it work? Yes, it could work. Look over here. I mean, storage gets crazy sometimes. So could it work? Absolutely. Would it be much safer to enter here when it's not overextended from the base? Yes, 100%. I'd rather find 10 setups like this and set up an order for all 10 than 10 setups like this and set up orders on all 10. Statistically, some of these are not going to hit, but the ones that do are more likely to be successful than entering, overextended from the movement monitor and technically during a micro downtrend and at a place where, we have this overextension. I might have repeated that, but at any rate, let's go to the next one or the next part of that. So in that scenario, it was not relatively close to the movement monitor. We could do better, right? We could absolutely do better. Avoid entry when overextended significantly from relevant movement monitors. There's obviously different movement monitors that correlate to different time frames. And so what you can do, just so we all are very clear on this, what you can do to kind of like account for that, you can place a horizontal ray on one chart, and there it is, right? 0.6460. Now my movement monitor is going to be different on the 4-hour. I'm even more overextended from the 4-hour, right? So I could literally, just to kind of show like perspective-wise how different they are, that's where the 4-hour is. So I'm quite extended from the 4-hour. Now let's see where I'm at from the day. Let's give us even more perspective. And overall, I'm not really that overextended from the day. Because how overextended could the day be, really? That's a great way to look at it, another perspective. Like here's where this particular batch of price action left the day, and it shot up here. And so there was a moment in time when it was all the way up here and the daily was down here. So by this logic, a person could say, you know what, I'm kind of comfortable. If I could just get a low leverage short somewhere, low leverage long somewhere in here, I know that the daily price action for this thing could go as far as, something like this. It could even, because it's storage within a couple days, probably overextend to that degree. Now, would I want to take profits here? Probably. But if this movement monitor turns orange, then I might want to kind of adjust my expectations for something a bit longer term. But right now, I like that storage is green. I like that it's orange breakout bar. I like that it's kind of primed to turn orange as far as the movement monitor goes. And I think we're in a place where it could easily go quite bullish right here. And I think there is a high degree of probability that this might be a great entry, right? Somewhere between the 4-hour and the 2-hour could work. But we also have to kind of acknowledge that the volatility monitor is still here on the daily time frame. So that's how volatile it can be, right? So this just helps us get perspective as to just how wrong we could be if we commit to one idea. And when you know how wrong you can be, it helps you set risk mitigation accordingly, right? So again, going back here, this is probably like a reasonably safe area to enter storage, right? Something like that. So it's just before the 2-hour movement monitor, and it goes down into the range of the 4. And you could literally kind of also use this data to look at the volatility cloud data from the 4. You make sure that it's set to the appropriate time frame, and you could literally go down here. Knowing that it's climbing, your risk should only drop, right? This is not really that bad though. If I could catch a ride up to the turquoise line, if I entered there may be a moment in time where I'm down on my position, but with a 3x leverage, I could just say, hey, I'm going to risk, 3x. I'm going to risk about 6% on this set it and forget it type position. I'm willing to do this because I'm the kind of person that likes to go to my job. I just want to check in later and see if I was successful. And this is literally the kind of trade where you could literally check in and see if you're successful days later. You either will be or you won't. But there's some logic behind believing that this could be an inflection point on the way up. And there's some logic behind believing that it could go as high as this turquoise line. But we'd want to be cautious and probably have a take profit here. We'd want to have a take profit here. So if you were a set it and forget it person, you would want to have 1 take profit zone, 2 take profit zones, and then 3 take profit zones, where you ideally front run each of them, right? So if it gets here, I'm taking profits there. If it gets here, I'm taking profits there. If it gets here, I'm taking profits there, just below each resistance, right? Because that's what smarter traders are generally going to do to ensure they get to take their profits. And if they miss out on, the fraction of whatever it was that they didn't get, they're okay with it. I think the best traders are the ones that are the least emotional, the least greedy, the least fearful, right? They just have a plan, they have logic, and they stick to it. Okay, so let's see, is my entry, we talked about that. Avoid entry when overextended significantly. The 2-hour and the 4-hour are often good ones to review for scalping and intraday. So we talked about that. Actually happens to be the 2 dotted white lines that I plotted. The reality is those are not bad statistical places to look for an entry on storage. Storage is very volatile, so it could go past that. That's why having the volatility monitor is so useful, and ensuring that you're using the appropriate setting, right? But each of them is there to provide you logic, right? So if you use the dynamic or the agile, you just look at the past 20 or 30 candles, or you look at some of the previous candles. If there's blatant disrespect of the volatility monitor in its recent history, don't trust that one. Go look for a different one, right? If all of them are blatantly disrespected, then you're looking at really small time frames that are less predictable, and you need to just find some time frames that have more respect, right? Where the red lasts longer, the green cloud lasts longer. Maybe that's the 4-hour, maybe that's the 1 day, but find the time frame that the volatility monitor is more respected in and use that. And also look to see how much has the price action tested that volatility monitor in that time frame. If it never even gets close, you may not want to use that data for your entry if you're going to use a volatility monitor based entry, right? After all, price action has never even come close to the volatility monitor area. So if that's the case for that given time frame, why would I use the 2-day for my long entry or for my short entry when it's never even come close, right? The movement monitor might be a better entry, or there's a different time frame that I could use that would be a better entry. In the case of storage, which we just kind of went through, the 2-hour and the 4-hour seem to be good. Should I go to the 12-hour or the 1 day? Possibly, but I could go and I could evaluate those. Again, if the price action has never come close, maybe don't use it. If the price action has come close, but it's always respected that movement monitor, that might be one that's good for a preset entry or to use as a stop loss if it's always been respected. But look for the level of respect is my point. You have that data right in front of you, so to not utilize it wouldn't make any sense. Okay, so next, the 1 day and the 3-day are more appropriate to review for multi-day swing trades. When taking positions on overextended price action, you will want to consider the smaller time frame data. So let's take a look at that, right? Let's just take a look at the 1 day. Gives us some perspective, right? So it says, okay, the 1 day, I'm going to delete these. Okay, the 1 day says we're in a downtrend, it gives us a reason to make this volatility monitor area or this cloud our take profit zone, right? So if in another place I was thinking of it going higher, it says be careful because if you think it's going to go past the turquoise and you want one more take profit zone, make it right around here, right? Because there was a time when it tested it, and technically that would have made an excellent take profit zone. We're still in blue movement monitor conditions. We know that can last a while because the whole purpose is for it to evaluate volume as well as sensitive trend analysis. So we know that we're in a bigger picture bullish configuration, right? Because we see the green channel and how much, how big and long it is. But we also know how much price can fluctuate within that channel. So we know that if this is blue, unlike some of the other ones that we looked at, this says that technically there's still good propensity for this to drop, or being that this is the 1 day, it could easily come up here by tomorrow or the next day and then drop, right? Because we know that's what blue movement monitors often do. So again, you can get data from the 1 day time frame, and you can plot data from the 1 day time frame that'll be applicable on any chart just by using it, right? There is my 1 day volatility monitor. I can even type that on there if I want. Dotted white line is 1 day volatility monitor. And then guess what? I get to go back to my 4 hour, and I get to know that, hey, even if this is successful, that's as high as I think it's going to go. That's where I want to kind of consider shorting. So my take profit zone based on this trend is my short zone. So see how the bigger picture for near in this case kind of looks like that might be a good place to find a short, right? It's the top end of that channel in a very, very obvious downward sloping channel. We have really nice respect starting there, there. See how volatile it is, there, kind of came up here. And so, based on this current trend, it's expected to maybe go as high as that and to maybe go as low as that. And then you have two pressure lines here. And so that might be a good, place to long, low leverage long, because again, near moves very quickly. So you want to be cautious using high leverage. But you could actually change the colors on these two. You could say, this is where I want to short, right? Maybe that's how you use those lines. And then for later reference, you could put a ray here, and you could say just above those pressure lines, that's where I want to long, right? And so that might be an excellent place to evaluate your asymmetry. You could even set alarms on these lines. You right click, you click on horizontal ray, and then you just literally put the alarm name that you want. On premium plan, you have access to, I think, 300 or 400 alarms. And quite a few on alarms, on drawings. And so that's a pretty amazing thing that you can do. And then you're setting yourself up to long near pressure lines on the proper side, getting ready for the bounce at a very deviated part of the channel here for near on a pretty large time frame. And then you're kind of setting yourself up for the exact opposite for a short here, right? And then you could always check Bitcoin and kind of see what's going on there to make sure you're not fighting Bitcoin's trend. Because obviously when Bitcoin is bullish, near will probably follow. So it's a dangerous time to short. But otherwise, these are just some things to consider. And again, if you happen to be able to place a short near this section of the channel, and it also happens to be backed up by, let's say, a couple pressure lines, then you're in a great position to utilize the channel, the pressure lines. Let's just say the volatility cloud was up there. That's a great place to triple stack your resistance expectations and your logic. And then using that logic, you can kind of like figure out what you want to do, how much leverage you want to use, how precise you want to try to make it, things of that nature. And so the big picture is we've been going down for a while. So if you really kind of think about it, we're questioning, is this a bottom for near? Is price action going to decisively turn upward, right? But right now, we can't really be certain. So these are just some things to consider, right? These are not the same conditions storage was in. Storage is kind of a different example. Storage had already, let's see, 2 hour especially, right? See that price action already getting rejected. but storage had, again, it needed to revert back toward the base in multiple time frames. And then we kind of see, how does this work? Could I get a 2x leverage trade out of it? And that's a beautiful one, because that's one that, even though it's storage, I don't really have to watch it too closely. If I lose 4%. If I succeed to the tune, again, on a 2x leverage trade, I succeed to the tune of up to about 46%, right? So do I have some resistance in the way? Yes. But is it possible, and does it have logic backing it? Yes, it does. It could easily make it here. And so I have just enough to just say, hey, if it only made it there, okay, that's not bad. But if conditions stayed conducive, could it make it up here? Yes, it could. And that would make it really, really well worth it, right? Because my risk-reward ratio here is 5, which is Paul Tudor Jones standard. And I think it's a realistic 5 based on logic. And then my risk-reward ratio here is 12. With a 23% ROI target, which again is based on logic behind channel theory and pressure line theory and the history of this channel, right? Which is based on math. This is not a hand-drawn channel. This is literally based on real math. So kind of keep that in mind. It's useful, especially when you add it all up. Okay, so let's continue on. We've talked about the price generally retraces to the base, or the base will need to catch up to the price action. So kind of keep that in mind. Price generally can retrace to the base very easily when it's overextended, which we've kind of discussed. In the case of storage, we're kind of looking for that. Or the base will have to catch up to price action, which means price action will stagnate and it'll just kind of range in a tight area for a little while, waiting for the base or the movement monitor in the context of this to catch up, right? So those are some things to consider. Avoid anything overextended from numerous bases in a majority of time frames. If everything is overextended from a ton of bases, it's just a really, really bad time statistically to follow it in. Could you? Yes. Could you win? Yes. But are you really more gambling? Yes, right? Because you're doing so emotionally, not based on logic or statistics. Okay, next,